Thank you for registering and making the time to join us for this webinar this afternoon on generating income from real estate debt. We've still got quite a few participants still joining. I might just wait another half a minute, and then kick off. The agenda for today is reasonably focused, which is about generating income in 2020 and how we can do that using real estate debt. And of course, what is real estate debt, the sector, market outlook, and how our funds performed through this period. At the end of it, there'll be an opportunity for Q&A, and I'll provide those details shortly. But I'll also introduce Damien, who's also presenting with me and is also the portfolio manager for the Freehold Debt Income Fund. Damien?
Good afternoon, all. How are you?
For Damien's also the head of real estate at Alceon, and myself, I manage the Freehold Debt Income Fund at Freehold. So getting straight into it, as I said earlier, we won't answer questions till the end, but please submit any questions you have via Zoom portal. The Zoom portal gives you an option, or you can email communications@freeholdim.com.au. Again, that's on the Zoom portal, or communications@freeholdim.com.au, and we'll endeavour to answer as many questions as we can at the end. In terms of our approach in real estate debt, as most of you know, there are several real estate debt offerings in the market. Across our property funds, as well as real estate debt, we generally take a conservative approach. We prefer conservative or lower LVRs over a higher return, as well as a bias to quality. That is, we prefer partnering with financing with developers that have a significant track record of delivering projects, and importantly, product that home buyers demand. In terms of experience, the team has invested $3 billion across 240 projects, which accounts for about $15 billion in end project value over the last 8 or 9 years. Problem, or the issue of generating income in 2020, excuse me, is obviously not just an issue for 2020, but has been an issue for a number of years. And with where rates are at the moment and where markets are at the moment, that problem's even worse for a lot of investors. I think at the moment, the best term deposit is around 1.5% per annum, as you'll see on the left-hand side, but obviously gives you comfort from a capital security perspective. At the other end of the chart, you have Australian shares and international shares. For Australian shares, yields are probably around 4% per annum, and in shares somewhere between 2 to 3% per annum. Given recent market volatility, and some of which preceded COVID-19, there are certainly some concerns around security of underlying capital, especially with listed Australian or international shares. Direct commercial real estate continues to be of interest to many, where yields are still around 5 to 6% per annum, but there are some near to midterm issues to work through, given the impact of COVID-19, and liquidity also tends to be available in 5 or 7 year cycles, depending on how long the syndicate or fund liquidity might be open for. Real estate debt, and we believe real estate debt is a very attractive investment class in the current climate for the yield, capital security, and the liquidity it offers. The last point, liquidity, is important to note because the average term of the loan tends to be between 12 to 24 months, and hence investors can be repaid periodically in a well-diversified fund. So, understanding what real estate debt is. it's important it's important to understand what we mean by real estate debt. That is, what is it financing? Firstly, land finance. As the name suggests, it is simply the financing of land acquisition or hold while the developer is working through the DA or pre-sale process. Construction finance, again, as the name suggests, it is financing the construction period of a development, which for a residential subdivision is a civil works, that is roads, sewage, electricity, etc. Or for an apartment building, it's the construction of the building itself. Residual stock. So once the construction is complete and the developer has not sold all the lots or apartments, they can obtain residual stock finance. This allows them to pay back the more or relatively more expensive construction finance and slowly sell the remaining lots or apartments, and then of course repay back the residual stock facility as well. Finally, commercial asset finance. This is typically for a commercial office asset, or for example, a retail centre to finance the acquisition or release, upgrade an asset. It tends to be typically, over a 2 to 3 year period. Damien, did you want to add a comment here?
Yeah, I would say that our focus tends to be on the first three of those boxes. The commercial asset finance tends to be dominated by the traditional banks, and the opportunity for us there really is if we go beyond the sort of loan to value ratio that the traditional banks might lend at. But the other three, mainly residential, but across other asset classes as well. We tend to provide land finance at a very lowly geared level. Land tends to be, in the residential space, very elastic relative to house prices. So we probably don't lend beyond a 40 to 50% loan to value ratio against land. Residual stock is a feature of the market really in the last couple of years, where projects delivering apartments and completed houses have not been fully sold on completion. There's a very deep and liquid market to provide finance against those completed stock units and replace the higher cost construction facility, generally with a 60% style lend against the residual stock value. And construction finance, which can be residential and non-residential, but we're probably more active in residential being the deeper market, is the space where everyone competes, really, the banks and the non-banks. Generally, actually, we would lend at a lower LVR than the banks, but we would be more flexible on our terms. So we're probably at 50 to 60%, maybe 50 to 65% LVR in that space. So all of this debt is first mortgage secured debt. Thanks, Omar.
Yeah, thanks, mate. And as now that we, I guess, have some background as to what real estate debt is, it's important to understand the risk-return relationship. Here you have the typical financing or capital stack for real estate asset, or arguably any asset. At the bottom, you have the equity or the owners of the asset. As the owners of the asset, they generally make the highest return, but are also the first to lose money or capital if something goes wrong. At the top of the stack, you have secured debt. This is the first to get paid in terms of returns and capital, and the last to lose any capital if anything was to go wrong. This is where you make the lowest relative return, but that's also because you have the most secure position. And it also tends to be where, as Damien said, we tend to focus. Sometimes you also have a mezzanine or mezz layer that sits between the equity and secured debt. They get paid after secured debt, but before the owners or the equity. And as you'll be able to see on the slide, the returns relate to the relative risk position of the investors in any given position in the capital stack. How you make or generate returns in real estate debt is reasonably straightforward. The interest paid by the borrowers is either capitalised, So all the interest is accrued on a monthly basis, but paid at the end of the loan term. Or interest is paid periodically, which again, most people will be familiar with, which is all the interest again is accrued on a monthly basis, but can be paid at the end of a given month or quarter. Generally, this tends to be our preferred structure because we try and pay investors a monthly distribution. And so aligning the loan portfolio with that is obviously helpful for us and the fund and investors. So far we've covered what real estate debt is, the risk return in real estate debt, and how the return's generated. Now let's look at why this sector has been growing and will continue to grow. And this chart has been sourced by APRA. APRA releases every quarter the exposure by banks in Australia. So that's Australian-owned banks and non-Australian-owned banks, so all banks in Australia, and their exposure to residential development. As you'll see, that from about the GFC, and this hasn't been a new phenomenon because of the recent Banking Royal Commission, this started well before that. Banks in Australia, due to regulatory pressure, have pulled back significantly from financing real estate, and hence their market share continues to drop. And the share of the non-bank providers, again, continues to rise because they've stepped in to take up that market demand. But even so, we're still well off global benchmarks of non-bank market share or non-bank participation in residential markets. And I know, Damien, you've obviously been in the market for quite a bit of time, and you'd have noticed the increased participation on non-banks.
Yeah, that's right. The Australian market has historically been dominated by the traditional banks, and the non-bank share has been historically less than 5%. Post GFC, with the APRA restrictions that were enacted in around 2014, we've seen the non-bank share of the market almost double, from that very low number to probably just under 10%, but still well below the global average. US, Asia, Europe, the non-bank market is somewhere in the 15 to 20% range. So we're a relatively immature market in that sense, but that's where the opportunity set lies. And we've probably seen the traditional banks' appetite wane further, during this COVID period as well. Thanks, Omar.
Do you want to try this, Damien?
Yeah. So developers pay a lot more for non-bank finance than they do for traditional bank finance. And the reason that they're open to paying that more expensive cost of funding is really the certainty, the speed and the flexibility of that funding. So the banks do have restrictions that APRA impose on them that just prevent them from doing certain loans. So an apartment development, construction finance facility, the banks generally require between 90% and 110% coverage of their facility from net pre-sales. And that's just an absolute requirement of their risk department looking through to APRA. Whereas we can be more commercial when we look at that, and we might be happy to fund at 50% pre-sale coverage, but at a much lower LVR than the banks might lend at. So we might lend only 50% of the required funds, noting that we've got less pre-sale coverage, but then less market risk if we're lending at that lower LVR. So we do look at every opportunity on its merits, and we structure for downside protection. And that can include looking for other recourse security outside the primary security. But particularly the private developers use non-bank finance pretty extensively in the development space. Thanks, Omar.
Now we'll briefly cover a couple of slides, or focus a couple of slides on the market outlook, because no doubt a lot of people certainly have been speaking about it and reading about it. And again, I'll get Damien to give his perspective.
Thanks. So the market commentary has really moved over the last couple of months from when COVID first hit. I think, market commentary for the residential space was pointing to a decline of some commentary at 5% and some at 30%. But I think firstly, as our health performance has been relatively positive, and secondly, the stimulus packages that the government has put in place, I think have led to a firming of those forecasts. And our house view is that, a decline of around about 10% in 2020 is a reasonable forecast for us, with a flat or negative market through 2021 as well. And that seems to be the consensus. The significant negatives weighing on the market, net overseas migration, which is predicted to drop 30% this calendar year, and 85% next calendar year. And the unemployment rate, as you'd be aware, recently announced is just over 7% unemployment rate, with prediction for that to go to 10%. Seems to be the market consensus, and then recovering through 2021. But obviously those, population growth and the employment of the broader economy really do drive house prices in this market. But on the next slide, Omar, the two really significant positives are historically low interest rates, which are expected to remain low for the foreseeable future, and the home builder stimulus package that was recently announced, which contributes at a federal level $25,000 per dwelling, in addition to the state incentives and initiatives that are either in place or are coming through. Now, with that backdrop, if you think about a 10%, 15% decline in the residential market, our senior debt remains for us a very good place to be on a risk-adjusted basis. So we are mindful of that outlook when we assess any new opportunity. So we will bake that into our underwriting to ensure that we maintain the sort of coverage that we would want. And the debt fund has an average LVR of less than 55%. So on that basis, we can sustain a very substantial decline in the residential market before we're losing any principal or return. So we remain comfortable that senior debt, lowly geared, which can deliver these sort of high single-digit returns, remains the best risk-adjusted opportunity in the current environment. Thanks, Omar.
Damien. I'll briefly touch on the last section before we go into Q&A this afternoon, which is fund performance. And fund performance has generally been good. 8.63% per annum annualized with monthly distributions. Now, as I said, this is a great return, but to my earlier comment, and also, I guess, emphasizing what Damien just said, it's important to understand the risk metrics in the underlying portfolio as with any debt fund, whether it's this or a syndicate or any other asset within the debt space that you're looking at. The return has to be looked at whilst also considering some of the underlying risk metrics. And what that really means is you want to understand leverage and hence capital buffer in the portfolio or protection your capital has if anything goes wrong. This is the weighted average LVR. So the weighted average LVR for this portfolio at the moment is, as at 31st of May, is 53.5%. And that's, we consider that to be relatively conservative. 98% of the portfolio is secured by Australian real estate on a first mortgage basis, or senior debt, as Damien just called it. And again, that is, we get our money back before anyone else, before anything else, if anything was to go wrong. Average duration. Again, this is something I raised at the start of the presentation about liquidity. This is the average term of the loans in the portfolio, which is 13.9 months. So most of our loans will mature within the next 12 to 15 months. So if I'm going to jump back to a slide, so with the in the top table, you'll see the 1 month, 3 month, 6 month, and 1 year return, as well as this inception return. And the bottom two rows in that top table, you'll see the distributions paid, and over those same periods. And in the bottom table, you'll see what the fund returns each month and the distribution it pays in each given month. So it's reasonably consistent, and it's important for us in the portfolios or the loan portfolios that we hold, for us to be able to pay that distribution to investors. And finally, what I quickly want to touch on before we get into Q&A is a key summary of the fund, which is we target a return of about 7 to 8% with monthly distributions, and since October 19 has returned 8.63% per annum, net of all fees and expenses. The fund's maximum LVR for senior mortgage is 65%, but as I said earlier, at the moment it's a conservative 53.5%. The fund's diversified across 33 loans, with the majority in 5 investments. The team has a significant track record, and importantly, it's transparent, where all fees charged are disclosed to investors in the information memorandum, and there's no skim or a share of the interest paid by the borrowers that we or the sub-investment manager take before it's provided to investors. With that, what I'll do is I'll just quickly check on the questions. So again, if you have any questions for Damien or myself about the fund or real estate debt market or the market outlook, now would be a good time to share them. Again, I think at the top you should have a Zoom Q&A option, or you can also email them to us at communications@freeholdim.com.au, and I'll just go through the first couple that have come through. Damien, you've somewhat covered it, but I might ask this again. So the question is, if you're expecting residential prices to be lower, what does that mean for the fund? Do you mind covering that again?
Of course. So Omar mentioned that the average LVR of the facility, which is predominantly residential, there's a couple of medical centres also that we're developing and funding, but predominantly residential, is just under 54%. So what that tells us is that we could sustain a more than 40% fall in the residential market in broad terms before we have any impairment on our facility. So it's certainly not our view that a predicted 15% decline could become 40% or more. So I suppose we generally feel that in a world where the residential market has dropped by 50%, there are worse places potentially to be invested than in senior debt against residential.
Thanks, Damien. Yeah, that's right. Again, re-emphasising that slide, I think around capital security, which is with senior debt, you're at the top of the stack. So the first to return capital obviously have the greatest degree of capital security. The next question is, what is the difference between this fund and a contributory mortgage? So this fund is what we describe as a pooled fund. So ultimately, a contributory mortgage fund or a pooled fund finances the same asset. But for the investors, the experience tends to be a bit different. In contributory funds, investors contribute funds to finance generally a single asset or loan and are repaid their principal at the end of the loan term. In pooled funds, investors invest in a diversified pool of loans and generally don't have to wait till the end of a given loan to withdraw their capital. So as an example, in the Freehold Debt Income Fund, after the first 12 months, you're generally able to apply for withdrawal on a quarterly basis. Next question is to do with returns. I'm just going to move to that slide because this question relates to that slide, and it'll be easier for everyone to understand if I reference the slide. So the question is, why are net distributions lower than net returns? So because we invest in loans only, so there's no capital gain as such to be generated from this style of fund. So 100% of our net or return after fees and costs is paid out to investors, and generally that is paid out in whole on a monthly basis. But from time to time, we might be investing in capitalised loans or loans that have differing time periods for payment of interest, and hence they don't fit into the monthly distribution cycle. But over a given 12-month period, you'll generally find that that net return, the annual net return, and the distribution to investors should align. Excuse me, as under Australian tax laws, we have to distribute 100% of the net income to investors by every 30 June or at the end of every financial year. I think that's it for questions. If you didn't get a chance to ask a question today, or you still had any queries, please don't hesitate to reach out. Again, communications@freeholdim.com.au is probably an easy opportunity, or by visiting the Freehold website. And thank you for participation, and again, hopefully that was useful to everyone. Thanks, Damien. Thanks for helping out.
Thanks, Omar. Thank you all.